Thank you. I'm going to give the talk in English, so I hope that's going to work. If you don't speak English, then hopefully the video recording will be useful and we can do some translations after. So thank you all for coming here today. Tokyo is one of my most favorite cities in the world. I don't need much of an excuse to come visit here. After the Satoshi Vision event that was on the other day, I was wandering home, and isn't it amazing to see billboards with BitCoin all around, and it was something that we could never even imagine. I mean, we imagined it would happen, but when you actually see it, it's an incredible thing to see. So Tokyo has a very rich history, as you all know. I'm sure you've been involved in the community for a long time, and this is one of the most buoyant communities in the world. So it's always a pleasure to come here. What I'd like to do today is I'd like to present a little bit on the Bank to the Future project, but I'd like to do it in context of some of the history. And then I'd like to, once I go through the project and some of the things we've been involved with, I'd like to go through some future predictions and forecasts for this industry, which I think will lead very nicely into Roger, who has kindly agreed to come here tonight and debate one of the most hot topics, I guess, of our industry and of our sector right now. And we'd like to give some different perspectives and discuss that and some of the issues that I think our industry really needs to deal with as we move forward. So for me, it all began in 2006. This was me working at an investment bank. I was a market maker on the London Stock Exchange, and my job was to manipulate London Stock Exchange stocks up and down and try and get people to buy in and buy out and scalp my little piece out of the market. Prior to that, I was a stockbroker, and then I decided, after spending a couple of years trading the markets, that there must be something more fulfilling than just trying to take my little piece out of the market and make the investment bank richer and richer. And I decided that I wanted to learn the business side, so I worked in corporate finance after that. And in corporate finance, my job was to take entrepreneurs that are at the very, towards the end of their journey and help them go public on the London Stock Exchange through this strange little thing that some of you might remember that used to be called an IPO. I don't know if anyone remember those things. At this time, I did that for a while, took a few companies public as part of the team. And I decided in 2006 that it was time to throw the corporate towel in. I wanted to return to, I did a master's in economics at the University of Manchester. And throughout my whole master's, I completely disagreed with some of the models that we actually use to model our entire economy, our entire financial system, and the world as we operate today. And one of the things that I really disagreed with was the model that we were being taught about money. I was being taught originally in the economics textbooks, right in the first year economics, that banks are an intermediary between borrower and lender. It turns out that they're not really an intermediary between borrower and lender. They're a lender with a license to be able to lend money that doesn't actually exist. And now it's reached the point where they don't even really need your deposit, depending on what type of bank it is. And it's not, your grandmother's savings being lent to somebody. So I question that. And then the next thing they taught me was, it got a little bit more advanced, and they taught you this thing about a multiplier effect, this thing called a money multiplier. And then when you dig a little bit deeper, you find out about this term called fractional reserve banking. And essentially the theory is that the central banks don't actually create money. They create these things that sit in our pocket called notes and coins. But digital money, digital currency, was originally invented by banks. We think of Bitcoin as one of the first digital currencies. Well, Bitcoin was one of the first decentralized digital currencies, but way before that, banks were actually given the ability to take the money that your government was creating and create a digital version of it. And it sits inside your online banking. If you log into your online banking, then that money is actually created by a bank. It's a digital currency. It's not backed by anything. It's just a digital representation of the paper and coins that actually the government and the central bank do create. And so I got really, really geeky in 2006 and got so obsessed with this subject that I decided to quit my job, and I did a load of blogs and wrote full time on it, and wrote a series of articles that became the precursor for my first published book called Bank to the Future. This is my wife, Bliss Dixon. She's in the audience. Where are you, Bliss? She's here somewhere, hiding right now. But I got so obsessed with the subject that we actually sat outside the Westminster Parliament during the G20 riots with a little sign on our heads with literally my telephone number, asking anyone to call me so that we could discuss money creation and its role in what I was believing would be a very systemic risk event in our financial system. But it took, at that point, nobody would listen. No one was interested. I was reading papers on the, different papers on the Bank Charter Acts of 1600s and when the Bank of England was formed and all these other papers, and it was a really boring and academic subject. But then, in 2008, people actually started to turn up to my talks, and people actually started to get interested in this subject, because the entire financial system almost imploded globally. And suddenly money became an interesting subject. We were told that it was very different things, but I believe that the foundation of all of these troubles was that we were operating on an incorrect assumption about how money is created. For example, the models in economics assume that we work off a fractional reserve banking system. Now, most people, when they hear about fractional reserve, at this time, that word was, people didn't even believe me if I said that banks have more money than they have on deposit. It was something I had to really persuade people at the time. And it was a very controversial subject, and spent most of my time just trying to persuade people how the banking system works, because people just didn't actually believe it. But then more and more people would come along, and it turned out when I really looked into the financial system that even fractional reserve doesn't even exist. There is no fraction and there is no reserve. The reserve consists of money that's created through this financial engineering, and you used to have to keep cash, cold hard cash on reserve, or gold, but then that became something that you could loophole. And then there was no fraction because the retail bank was required to hold a certain fraction of the reserves, but then they invested and created investment banks that would use financial engineering in order to loophole all those reserve requirements and leverage 300 to 400 times over. And so there was a way to get around both the reserve and both the fraction. And so therefore, it's even worse than fractional reserve banking, once you even understand that. In countries like the UK, there isn't even that type of requirement. In the US, that's a US term, and in other countries, it got, we dug deeper and deeper and deeper. And so round about when the financial crisis happened, this became a very popular topic, and I toured about 200 different universities and colleges on the subject of monetary reform and banking reform. And then I did this little documentary. This is called 97% Owned. It was a documentary that was created in order to explain to people that we only have about 3% of money that's created by governments, and 97% of it is created by the private banking sector, and all that money that's created by the private banking sector is actually backed by debt, and therefore you have to have more debt in order to have an economy. And so you enter this cycle, this boom-bust cycle, where you're continually trying to push up interest rates when the economy gets too heated so that people don't borrow so much. And then you push them down to try and encourage people to borrow. And then when the economy gets too heated, you send the same people that borrowed the money bankrupt by pushing the interest rates up to cool down the economy. Boom, bust, boom, bust, boom, bust. And then this little documentary that we thought was like going to have known, I just looked it up on YouTube, and we're now at 1.9 million views on this documentary, which is fascinating. So this is around 2009. At this point, I had not heard of this group of people or this person called Satoshi Nakamoto, but I happened to speak at... I decided at this time to publish a formal published version of the series of papers that I put together called Bank to the Future. And in doing that, this Bank to the Future book, the ones prior to that were very, very boring and academic and went through the history of money and things that most people don't care about. But one day I woke up in the middle of the night and, Bliss, my wife, was woken up in a panic because I came up with this idea of Bank to the Future. And for those of you that haven't watched the film Back to the Future, I hope you all have, when I go and speak about this in China, it's lost on everybody because nobody's heard of the film Back to the Future. The funny thing is, my book has sold over 1 million times more copies in China, and I don't think they get what the title means either. But the purpose of the book was to describe this journey in time travel where we go through all the different crises over time. And we stole this, I don't know if you remember the film Back to the Future, where they have this sports almanac and they give it to him former self, and then he starts making bets based upon knowing the future. Well, we did the same with the banking almanac, and we kept giving it to these different people based upon these different innovations in financial technology. And I gave this whole journey and forecast about what was going to happen. But in the research of writing on this book, I was introduced, this person contacted me on Facebook, and his name was Johnny BitCoin. His real name was Jonathan James Harrison. And he sent me this message, I still have it on Facebook, and he was telling me, Simon, I've sold my house, I've moved into a squat in London, and I'm working with this group of developers on this thing called Bitcoin. And I thought that was a little bit crazy, but because I was writing a book, I decided to really look into this thing called Bitcoin, because he was telling me about this peer-to-peer payment system. At the time, we were talking in the book, it was like about PayPal and all these other things that were coming along. There was no WeChat Pay at that time. But I was looking into all this technology. And so we launched the book, and I believe that this book was the very first published book in the world that included the topic of Bitcoin once it was published the next year. And so here's 2011, and I spoke at Occupy London, and this is where I started to meet a few more of the very early Bitcoin community people. And I believe it was round about, as Roger's here today, and we're going to be doing the debate later, it was round about February 2011 that I believe Roger got into this and started evangelizing and investing in the industry. Maybe he'll correct me if I'm wrong later. But this was the very first Bitcoin conference in Prague in November 2011. And myself and Max Kaiser were speaking and hosting. There was this little startup pitching there, a gentleman called Tony Galippi that was pitching a little company called BitPay at the time. It was sponsored by this exchange that some of you might know called Mt. Gox. And the price of Bitcoin, I think it had crashed to around about $3 during this conference. And it was really around about 40 people in the room. I'd say 20 of them were hardcore computer scientists. The other 20 were anarchists and activists that wanted to take down governments and believed that this technology was going to change the world. And they were true visionaries, all of them. Hardly any of them could communicate. The presentations were barely understandable. But Bliss and myself left that day thinking that this room is full of a people that seems like they're actually going to change the world. Bliss was a bigger believer than me. I was looking more at it in terms of writing the book. But my wife had the vision to believe that this is something that we should really be looking into. At that time, we founded a company in the UK in 2010 called, we used the title of the book and it was called Bank to the Future. Now, when we registered the company, we were actually told that we needed to apply to use the name bank in our name, because it's actually a word that's protected by governments. And when you use the word bank, you're told that you actually have to have a banking license in order to do it. So because we'd already gone so far, we decided to take the A out of our name, and we pledged that day that one day we will get our A back and we will be Bank to the Future again. But then we started to realize, as we looked more and more into Bitcoin, that actually a world without banks was being created. And then we got really comfortable with the brand, and we didn't want the A back because we no longer wanted to be a bank. At the time, we were trying to create a non-fractional reserve bank because we were fed up of telling the governments what the future of banking would look like. And so instead, we were trying to show them, and it turned out, I remember we met with the regulators. Firstly, they told us that you can't have your name. And secondly, they told us, you're not the type of people that we would regulate or run a bank. You're going to have to go and find an executive from a bank in order to run this company. So what we decided to do is we were hanging around with a few people, and we set about trying to build a platform whereby people could invest in anything that was going to disrupt the banking system. And so the book Bank to the Future gave a whole forecast about this change, how technology was going to have an impact on the future of finance. We wanted to create a bank, but instead we decided to create a platform where we could invest and diversify in all of the different things that were going to change the banking system forever. The problem was, we managed to secure our, it was a group of us, about 3 different companies at the time, and we were the very first group of companies in the world to persuade a regulator to allow people to invest online to try and disrupt the venture capital industry. About 3 years after we persuaded the very first regulator, the FSA in the UK at the time, it's now called the I forget now, haven't been to UK and regulators for a while, but we managed to persuade them, and it was the very first company that allowed people to invest online. Now the problem was that we were only allowed to work with UK businesses and UK investors. And they put together a special legislation that allowed for this investing online. I believe this was the precursor to ICOs. 3 years later, America copied the work that we were doing and created this thing called the Jobs Act. And for about 3 years, trying to change the laws to allow people to invest smaller sums online and pooled. Then in 2012, all of a sudden, people were actually really interested in this thing. And Max Kaiser invited me on the Kaiser Report, and all these TV shows were interested all of a sudden in this subject. And because we were getting really pushing forward for this thing that was called equity crowdfunding at the time, we spent 4 years just trying to get a license so that we could allow people to invest online. And so this whole process continued and continued. In 2013, we were invited on TEDx, where I gave a talk on just changing the rules in banking. And that was the very first talk, I believe, on this subject on TED. And then in 2014, I gave a model for what I thought the future of fundraising would look like. And I believe this was the time that I gave the first forecast that this little thing that had come along called ICOs, the first one was something called Mastercoin, was going to be bigger than the IPO market, and I called that on TEDx. You can still look through the archives and see that video. And at this point in 2015, we got fed up of, now, if you think about it, we were getting, the Bitcoin industry was getting bigger and bigger and bigger. We had all the scandals, we had the Mt. Gox, we had the bear market. At this point, round about 2015, we had a really, really long bear market where nothing was really happening in the industry, but lots of people were building and building and building. And we decided at this point that we were going to dedicate the entire platform just to supporting the Bitcoin industry. The problem was that there were hardly any businesses. Roger had invested in all of them. Roger was supporting, he was doing the seed rounds in many of these companies. And because the regulators would only allow us to have UK businesses and UK companies, this was a time when no one was really interested in investing. So let alone could you find a UK company that wanted to work with Bitcoin, then you had to try and find the investors, and you were just restricted to the UK. And in the meantime, this thing called Bitcoin had come along, which was completely global, did not care where anyone was from, did not care about anyone's ethnic minority, country, anything. And we were trying to do this, and plug it into a system. So we decided at this point to move to Hong Kong, reincorporate the company in the Cayman Islands. We deregistered with the regulator there, and we registered with the Cayman Islands Monetary Authority as a securities business. And from that moment, the business exploded. Here's some of the companies that we managed to do the early funding rounds for. Some of the exchanges like Bitfinex, BitPay, Kraken, Bitstamp, BitPayza, Shapeshift, Bitso, largest exchange in Mexico, UnoCoin, CoinSecure, and over 100 different companies in the industry. Now, at this time, it was very, very hard to get equity. It was very hard to raise finance for these companies. There were only so many investors out there. They were very skeptical about the Bitcoin industry. And we were very fortunate to get equity in these companies in a time when you could actually get the equity. Nowadays, if you try and get equity in a company in the Bitcoin or blockchain industry, firstly, the companies are just not interested in selling it because there's this thing called tokens that's come along. And then the investors are barely interested in investing in it because there's no liquidity and they can't sell it. And I'm sure Roger has still got all those positions that he originally invested in those early days because the liquidity is just not there. But we built this portfolio and we were supporting the industry and we had several, let me go back. And in this, in the meantime, forward a couple of years, and several of these are unicorns. Every bank in the world is trying to buy all these companies. They're getting mergers and acquisition deals knocked on them every day. Venture capitalists are queuing outside the door to try and invest in these companies, and they're just ignoring their emails. Because after 2016, we created a self-funding mechanism whereby our industry no longer needed to beg to venture capitalists. And it no longer needed to try and persuade people that this was an industry that they should be looking at. And in 2017, we had the biggest bull market that we experienced in cryptocurrencies as a result of people being able to create tokens. And you say what you want about these tokens. You can say what you want about whether they're scammy or whether they're good or whether they're ripping people off. But one thing it did is it actually created a self-funding mechanism whereby our industry could raise the capital that it needed in an environment of rapid innovation. That allowed it to it became a self-fulfilling prophecy where we were able to fund ourselves, develop, create new innovation, global, bring new people in, have a load of people all around the world with no borders. So at this time, the equity markets was being completely disrupted. Tokens were raising more than the IPOs that were going on the markets. We decided at Bank to the Future to launch our token sale right at the end of in this year. And, I remember those early days. Bliss and I will tell you, we were begging people just to raise that $250,000, and we had to do 6 months worth of meetings trying to explain the vision of what we were doing, which was completely demoralizing to people that really didn't care about what we wanted to do. And then they ended up just giving us the money because they got a tax break by investing in us. Not the type of passionate investors that you want in your company, but they're very happy now with the value of the company. But we launched our token, we did a private sale for accredited investors. We wanted to show that this could be done in a compliant way. We registered with the SEC. We wanted to show that there was a way of doing this. We had to, although we're very happy investing in all the decentralization and the disruption, but at the end of the day, if you're not doing this decentralized and you're a person, then you're going to have to follow some of these laws if you still want to be here and see some of these changes. So we launched the BF token, and it was designed to solve a few problems for us. The first one was deals on our platform were getting more and more popular. Right now, you won't see any deals listed on our platform because every time we launch them, they just sell out straight away.